Brookfield Asset Management, with its $1 trillion of asset under management, has acquired Yes Communities in a transaction that is over $10 billion. That's the largest mobile home community operator in America. I mean, we're talking over 300 parks, 54,000 lots. This is a big deal, and regulatory clearance has already been granted. It looks like it's moving forward. And yet most investors, despite the massive institutional tailwind that the manufactured home community is seeing right now, will not so much as look at this asset class because of what they think of it, or because of a predisposition of what it maybe should be to them. Whatever. I'm gonna give you 10 reasons why I think that manufactured housing communities may be the most misunderstood asset in America, and maybe one of the best opportunities to park your money for the next several years in real estate. Here's where we are right now. The NAR, National Association of Realtors, says that the average first-time home buyer is now 40 years old. It's an all-time record age. And the median home price nationally is above 500 grand. So that average first-time home buyer has now hit a all-time low of the market share in the single-family domain of just 21%. So as you can see from this, home affordability is getting less and less affordable than ever. And I remember trying to buy my own first home. Now, I was living in California, in Los Angeles. I was seeing entry points north of $1 million for a starter home. And I thought, if this is hard for me, I'm a business educated, person who's got a stable career. What is this like for everyone else? I mean, I just can't even empathize enough with how challenging the situation is. And that question has been on my mind now for over a decade. How do we create more affordable housing? And naturally, that has led me to the manufactured home community world. Now, this area is surprisingly niche, but that's kind of what I love about it. And it's not because it's exciting, and it's definitely not because these are sexy asset classes, but it's because the math in the manufactured home community of creating affordable housing for other tenants and homeowners is better than almost anything I can find in the real estate world, especially when it comes to multi-family housing and residential type stuff. So in contrast, a new manufactured home averages about $123K. That's about $87 per square foot. When you compare that to $150, $165 for site-built construction, right? So there's a major difference in the price of these things. And we're talking, by the way, granite countertops, smart thermostat, open floor plans. Some of them are 3 bedrooms. I swear there are nicer mobile homes than $1 million homes in Costa Mesa or Santa Monica. It's kind of crazy how nice these things have gotten. And it's just not what a lot of us picture. So that gap between perception and the reality is the entire opportunity in mobile homes, and not a lot of people see it. Now, I spoke with a top 50 manufactured housing operator recently, and he told me that over 70% of their new residents were actually retirees, people buying homes and realizing that, they wanted private ownership and they needed to stretch their dollar. It's the same exact calculation. These people are not settling for less. They're doing the same math that maybe sophisticated investors do. They want durable value, but they don't want to, they don't want to die renting. Here are the 10 structural reasons why smart capital is flowing into the space. And by the way, this is not, my opinion per se. It's the structural reality of the fact that these are almost impossible to replicate in any other asset class. So let's dig in a little bit. Okay, reason number 1 is perhaps the most obvious, but this might be news to some people. Supply is essentially permanently locked. 70% of US counties have zoning that totally prohibits new manufactured housing communities from coming online. And we're basically talking about the ones that we're buying now, they're grandfathered in, they're as of right. So every year, some of them even get redeveloped into high density uses or become something other than a mobile home park. So not only are the ones that exist getting grandfathered in, some of them are being redeveloped out of being mobile home parks, which just makes the supply continue to shrink. You literally cannot build a new one in most metros. Now, number two is, like I said, infill is grandfathered in. Now, this is what a lot of investors miss. If your community has 100 pads and maybe 80 of them are occupied, the 20 vacant pads, you're allowed to put 20 new mobile home parks on. Just because you can't build a new one doesn't mean you can't bring your community up to 100% occupancy. So you can put new homes on those pads and not really have to deal with any zoning approval. And in a sector where, supply is essentially banned, the ability to bring new units to these existing communities creates value, not just for the residents to have more affordable housing units, but also for the investors, because you're going to increase the cash flow at the property. And that infill is an amazing growth lever to compound the value of your investment. Now, number three is that tenants stay in these parks. Now, when you own a home that costs $8,000 or $10,000 to relocate, you don't leave over a $25 or $50 lot rent increase. And the average mobile home park tenure is somewhere between 14 to 21 years, depending on the community. We see a lot of times 1-day move-outs, which is a resident sells their mobile home, they're not going to move it, and another resident comes in the next day. There's no change whatsoever in lot rent. Maybe if anything, it goes up a little bit. But compare that to the 2 or 3 years that people spend in multifamily apartments. The stickiness of the asset class is really foundational to this business model. Expenses in mobile homes are half what you see in multifamily. Now, especially when it comes to the tenant-owned home model, residents maintain the cost of their homes, and the community maintains the land and the common areas. So that means that 30 to 40% expense ratios are pretty common. Sometimes we even see 20%, as opposed to 50 plus in some especially like affordable multifamily. So that means less maintenance and a lot less CapEx, and more of every dollar that comes in comes to the investor's bottom line. Now, reason number 5, the demand is structural for mobile homes and mobile home parks, not cyclical. 22 million Americans live in mobile home parks. It's a huge number of people. And with median home prices over 500 grand, and that average home buyer being, 40 whatever years old, affordable housing demand is not going away. And even in recessions, that demand actually grows. But when the economy contracts, those communities, they fill up, because people tend to go out of, let's say luxury, and maybe go down a notch, right? That's a counter-cyclical demand profile. And you just don't find it in a lot of other investments, but it's really a key part of mobile home park investing. Now, reason 6, mobile home park default rates are among the lowest in commercial real estate. But even Freddie Mac, the giant agency lender, their multifamily credit director has confirmed that manufactured home communities have half the rates of default that traditional multifamily loans do. Half. That's Freddie Mac's own data. That's the agency, the lending agency's data. I'm not making this up. And it just makes sense when you realize, like, that tenant base, this is the most affordable option for home ownership. They're going to fight like heck to keep that home theirs, and they're going to keep paying. So this is really it's a fantastic asset class for protection of capital. Now, reason 7, institutions have taken notice, at least some of them, and are consolidating the space. Now, why would that be good for us? Why would that be good for retail investors and passive limited partners? Well, Brookfield has committed their $10 billion to acquire Yes Communities, and that's the largest operator of mobile home parks in the country. across 18 states, 300 communities. And they also sold $1.6 billion of communities in late 2024 and immediately bought back in bigger, right? So there's a lot of movement here. Warren Buffett and Berkshire Hathaway, they own Clayton Homes. It's the largest manufacturer of mobile homes. They've owned this for years. He's been a huge proponent of the space. And Blackstone and Carlyle are active. This is not a charity game. These guys see that there are dollar signs in the affordable housing space and that multifamily and single family homes are not going to be able to keep pace with the demand at the prices that are offered in mobile home parks. And that is creating this sophisticated capital lever, basically allocating and betting on this asset class at scale. Now, reason 8, new legislation may accelerate this shift. Now, this is actually something I haven't heard anybody say yet, but if you made it this far in the video, this is a nugget that really matters. And it's that in March 26, the US Senate voted 89-10 to pass the 21st Century Road to Housing Act. And that's what's basically banning large institutions from purchasing, single family homes at scale. As we've seen this kind of on the news recently. And so institutional capital, it looks to be prevented from flowing into single family rentals. What happens, right? Money needs a place to move. They're not going to just say, oh, we're done with real estate, we're going to go away. Well, manufactured home communities are one of the most logical destinations, and they're a total exclusion in this housing ban. So that roll-up pressure may be about to intensify from these institutions that are trying to muscle into the space. And by the way, they're not just trying to buy one park here, one park there. They're trying to buy portfolios of parks, and they're willing to trade at a premium for that. We're just now seeing that trend accelerate, but there's still lots of mom and pop owners that are in the process of selling their homes. This is our opportunity. That is my reason number 9, by the way. Mom and pop, they are retiring, but the time is limited to get these parks under contract and to get invested. About 70% of communities in America are owned by individual operators. So these institutions haven't taken the share yet. They're intending to, but they're not there yet. And many of these, these retiring, mom and pops, they own the homes, they cover the utilities, and they charge, typically below market rents and really don't have much of a succession plan. What do you think happens when, the non-real estate family members get hit up by grandma and grandpa or mom and dad who run a park, and they say, hey, do you want to take over the family business running our mobile home parks? Chances are the answer is no, unless they're watching this video. But we buy from these sellers, and most of the time we're buying off market. A lot of these people, they respond to mailers in the mail. They respond to relationship building, and the groups that we work with, the operators that we work with, they've been building these relationships for years. So, the model though, when we do go in, when parks are acquired, is that actually it's a conversion between what I described before, which we call a park-owned home plan, into a tenant-owned home plan. And what economically that can do is increase the net operating income, sometimes by 40, 50, 60% what they had before. Now, the last reason, number 10, modern manufactured homes are not what you think. And I said this in the beginning of the video, but these are nice and they are affordable nice. It's crazy to see, at $87 per square foot versus $166 for a home, what these actually come with. If you go inside the home, a lot of times you can't tell the difference between a mobile home and a stick-built single-family home in the same community. And even the $60,000, $70,000, $80,000 manufactured homes. Now, I also want to be straight with you with the risks of this area. And this is what good allocators do. If your investment groups that you circle or follow are not talking about risks, you might want to rethink the relationship. But number 1, which is really key, is regulatory and political risk. Here we're talking about, rent control that exists. You see this in California, New Jersey, New York, And as institutional ownership does grow in the category, we're going to see continued political scrutiny. So the operators who survive long-term are the ones who run these communities well. Now, risk two, and I think this is probably the big one that's on my mind constantly, is operator quality. Now, most communities are still run by individual owners and they don't have good systems. And that is our opportunity, but it's also the biggest risk variable. And when you're, converting park-owned homes to tenant-owned homes, it sounds simple, but it's actually pretty darn complex. When you're doing infill, you're coordinating to bring in new homes and you have to help with financing. Sometimes there's a lot of moving parts and pieces, and bad execution during that conversion can consume, your cash flow for years. And the alignment that they, have skin in the game and they understand what's happening in their communities is a non-negotiable for us. This is not theory. We have a Clarksville portfolio just north of Nashville, Tennessee, with 149 pads across 3 different parks. And we invested in this less than a year ago. We're already running 18% above the originally underwritten NOI. The basis that we bought in was about 46 grand per pad, where the market is running 90 grand per pad. And distributions are way ahead of schedule. Now, why am I saying all of this? Because you can compare that sort of performance in 2025 and 2026 to, let's say, multifamily right now. Now, it doesn't mean all multifamily is bad, and it definitely has a place in portfolios. Look, we still invest there, but pound for pound, the risk-adjusted math on a good mobile home park opportunity in a well-sourced community or with tenant demand and a decent MSA, it just hits so far above its weight class, and it's hard to beat in this environment. Or you could even compare it to the public markets. The S&P has been volatile. Bonds are, paying practically nothing, and REITs traded a premium to what they're worth. But in a manufactured home community, you're buying, real assets at a substantial discount to replacement cost, or there really isn't even replacement cost because you can't really make it again, with, cash flow that starts immediately on day one and pretty much near zero correlation to the public markets. So if you're looking at that space, you're, interested in mobile home parks, here are the 3 questions that I would ask on any deal. Number 1 is, what is the tenant-owned versus park-owned home ratio? Now, this is basically asking, have they already done that conversion? Higher tenant-owned homes means lower expenses and stickier residents and potentially better financing terms. It also means that maybe it's fundamentally been de-risked, but the returns also might be a little bit lower. But if the operator's plan is to convert from park-owned home to tenant-owned home, that's more of a value-add play, right? And it's worth it to ask them about how they've done this in the past. Now, opportunity 2 is, what's the infill? Now, we're talking about vacant pads that are grandfathered in, one of the most powerful growth levers in real estate. Do they have a lot of them? Is the property fully performing? Each one of those vacant pads could represent, additional cash flow that's going to drastically increase the NOI. So that's a key question to ask. And lastly, what's the basis per lot versus what the market is trading at? Now, I really want to see, some sort of a discount here. And if you're buying it, 40, 50, 60K per lot, and the market's trading at 70, 80, 90, your downside should be decently structurally protected there. And since zoning won't allow new supply, that gap is really durable in a lot of markets. Now, we have a new manufactured home deal in final sort of diligence right now. We're working with a proven operator we've done business with before. It's a really interesting deal. Same person that is running our Clarksville portfolio, absolutely crushing way over expectations. And we're looking at more and more opportunities in the space. If this stuff interests you, reach out, drop a comment, send me a message, or visit oceanridgecap.com and take our investor quiz to help you identify what kinds of deals would be best for you. But love to connect and try to help you get into the space if you're interested in investing here.